Your net worth, how do you compare? It's common for me to sit down with people who have done a really good job in life financially. And when we're going through the planning process and I ask them about their investments and their retirement accounts, I'll usually have people give me a summary of what they have. I'll write down how much they have in their 401k, and then we'll talk about their IRA and their Roth, if they have a brokerage account and a savings account and a checking account. And then after we kind of go through and we catalog everything that they have, I'll ask them, I'll say, hey, if you were to sell your house to me today, how much could you sell it for? And they usually say, oh, Jason, you wouldn't believe what's going on in real estate right now. And they usually are very conservative and will give me like a tax assessed value because they just can't believe what Zillow is telling them their house is worth. And then after taking an inventory, I like to ask them, hey, when you add up all of this, what does it come to? 8 times out of 10, people say, I don't really know. They have never added up the value of all of their assets. And this isn't a criticism, rather it's just an observation. It's just that people don't spend all their time obsessing about how much money they have or what their net worth is. And it's interesting for me when I get to point out to people when they are millionaires. Many times, this is something that nobody's ever brought to their attention. They didn't realize that they had achieved that level of wealth. They're just hardworking, thoughtful people who love their families and have saved along the way. And you know what? When you become a millionaire, you realize that nothing in your life changes. You're still you. It's not like you're going to go throw a millionaire party because people would just think you're a jerk. So you get up the next day, you go to work, you put one sock on at a time, and you go out and do what you've always done. You work hard. You try to make other people's lives better. And that's how the average person becomes a millionaire in America. Day by day, little by little. I think they say the saying is, inch by inch, life is a cinch. Mile by mile, life is a trial. Your net worth is the financial equivalent of looking in a mirror. It helps you to identify if you've been saving or spending. When you look at your net worth, you start to see where you're doing well financially and where you're falling short. Are you regularly calculating your net worth? Do you know how to calculate it? In today's show, I want to explain what net worth is, why it matters, and how to calculate it. And at the end of the show, I'll share one of the biggest net worth mistakes that I've personally come across. What is your net worth? Your net worth is the value of your assets, what you own, less the value of your liabilities, your debts, what you owe. An easy formula for net worth is assets minus liability equals net worth. The trick to calculating your net worth is understanding how to define assets and liabilities. Simply put, assets are things that you own that are worth money. Of course, assets include things like the value of your retirement accounts and your checking and savings accounts, but those aren't the only assets you need to consider. If you own property such as a home or a rental property, you'll want to count those towards your net worth. If you're a business owner, you should include a conservative estimate of the value of your business in your net worth. Assets can even include personal property such as vehicles, fine art, firearms collections, and rare coins. Compared to your assets, liabilities tend to be more straightforward. These are any debts you owe, including a mortgage, credit card debt, auto loans, student loans that you signed for the kids, or any other debts. So why does net worth matter for retirement planning? Retirement planning is an exercise in cash flow planning, but that doesn't mean that your net worth is unimportant. During your working years, it's easy to focus on your income and your salary as the most important part of your financial life. However, if you plan to retire, you won't earn a salary or full-time income any longer. You will use your assets to generate income, and your debts will be a drain on that income. A growing net worth shows that you're on track for achieving your retirement lifestyle goals. Your net worth is a key indicator of your overall financial health, especially during your working years. That's why in the retirement budget calculator, we include a net worth calculator for retirement, and that's why we created the snapshot report within the calculator so that you can track your net worth and you can measure and know how it's changing over time. The net worth calculator for retirement makes it easy for you to calculate and track your net worth. The retirement budget calculator breaks your assets into 4 major categories as follows. your liquid investable assets. These are assets that are easy to convert to income. They include the following types of accounts: savings accounts, checking accounts, money market accounts, CDs, retirement accounts such as IRAs and Roths and 401ks, 403bs, TSPs, etc. Brokerage accounts with stocks and bonds and mutual funds and ETFs. And then we break it into the next category would be real estate assets. So they might include things like your personal residence, rental properties, commercial property that you own, raw land, shares in a privately held real estate investment trust. Personal property represents the value of things that you own and use on a regular basis. Technically, you could count the value of everything from furniture to your old socks. However, most people just include the value of high-value personal items that they could easily sell. And these include things like musical instruments, jewelry, furniture, hobby equipment such as computers, stereos, tools, unused materials, etc. And then the last way that we break it down is through other assets. And these could be things like vehicles, recreational vehicles, collectibles, bullion, the estimated value of a business that you can sell. So those are the four primary categories where we break down net worth within the calculator. The next thing you want to do is add up all of your liabilities. Once you've established the value of your assets, you need to account for all of your liabilities. These can include any of the following: a balance on your mortgage or rental real estate that you own, home equity loans or a line of credit, credit card balances, auto loans, required alimony payments, required child support payments, judgments against you. Once you know the value of your assets and the value of your liabilities, calculating your net worth is easy. It's the simple formula: assets minus liabilities equals net worth. Over the years, I've had the good fortune to work with a lot of really incredibly smart, sophisticated people. A lot of these people are spreadsheet nerds. And I remember one time a couple of years ago, a couple came in and the husband had developed a very detailed cash flow analysis spreadsheet. On the right-hand column, it showed the value of their net worth changing as they transitioned through retirement. All the while, the spreadsheet showed that their net worth never went to zero. It appeared that they had enough money to last for both of their lifetimes. As I was giving them a second opinion, and as I was personally crunching the numbers, I realized that they had made a huge mistake. The net worth column included the value of their personal residence. They were assuming a withdrawal rate based on all of their assets, not their liquid investments. The only way to get money out of your house is to sell it or rent it or take out a reverse mortgage. So when I ran the numbers, I actually showed them running out of money in retirement compared with their calculations showing that they would never run out of money. You can imagine that appointment didn't go over very well. If you have to make a mistake in your calculations, wouldn't you want to know about it? And the sooner the better? It's important to remember that it's your cash flow that is most important in a retirement plan, not your net worth. Holding assets that do not produce cash flow may make you feel wealthy and increase your net worth, but at the end of the day, it's not the assets that are king, but cash flow that is king when it comes to retirement planning. Once we go through the exercise of adding up all the assets and liabilities, and we have broken things down into assets that are easily used for supplementing cash flow, then we can do a very simple formula to get a feel for how much of your investments we can spend in retirement. So let's say you add up all of the liquid investments and you realize that you're a millionaire. You've managed to save $1 million of liquid net worth. Now just take your calculator and multiply 1 million times 0.04. And it will tell you that if you have a 60-40 stock bond split, you should be able to withdraw about $40,000 per year and increase that withdrawal by inflation every year over the next 30 years and not have to worry about running out of money in retirement. You can multiply your $1 million or whatever that number is by 0.033 if you want to be more conservative, or by 0.055 if you want to be more aggressive with your withdrawal strategy. But you say, Jason, I currently make $120,000 a year. $40,000 of withdrawals is not going to cut it. But remember, in retirement, you get to add back in Social Security.